When it comes to capital raising, here's where deals usually die. And most of the time, they don't die during the phone calls with the prospective investors. They tend to die after, when the investor closes their laptop and they sit quietly with their thoughts. Nothing's necessarily wrong or obviously wrong, but something just maybe doesn't feel as settled as it should do. They're thinking, why am I still feeling uneasy about this? What am I missing? Why do I not feel ready yet? Once that feeling shows up, no amount of follow-ups are really going to fix that. So what do you do instead, right? You've got to design the deal so that after the call, there are no open questions left for the investor to wrestle with. They need to understand what the risk is, how it's structured, who's in control if something doesn't go to plan, and where this sort of sits in their world, their portfolio. When they're alone at home with their decision making, they're not trying to replay your conversation. They're actually moving forward. They're thinking things like, how do I want to fund this? Do I do it personally, or do I do it through an entity? Should I move some money from an IRA, move it to a self-directed IRA and do it that way? That's the shift that you want to have happen. And when an investor moves from evaluating a deal to kind of mentally preparing to move forward, the decision's already been made. And at that point, paperwork is no longer the pressure. It's just simply the next logical step in the process. That's what you want to manufacture.